It's the worst since Lehman. I'm your host, Steve Van Metre, and thanks for joining me today. And our top story today, we've been warning you that when this happens, it's game over for the U.S. economy. And now we're starting to see it begin as we've got some alarming data that shows the U.S. economy now is seeing something we haven't seen since the Lehman Brothers crisis. Plus, we've got more information that shows the central bankers have it completely wrong and that their fantasy of engineering a soft landing is actually going to turn into a hard landing. And we've got data from overseas that is confirming everything that we're seeing here today. Let's head over to Reuters, where we picked today's story up with the headline: U.S. job cuts over January through February hit the highest since 2009, since Lehman Brothers. And layoffs by U.S. companies over January and February touched the highest level since 2009, with the tech sector accounting for more than a third of the over 180,000 job cuts announced. And of course, we've talked about this in the past, that if the U.S. economy doesn't turn around in the first quarter, that we're going to see an increasing number of layoffs. They're starting to happen. And once they accelerate, it's game over for the U.S. economy. There's nothing we can do to stop what's about to come, as we'll see in the charts here in a little bit that validate that we are indeed going to face a hard landing. In February alone, layoffs in the United States stood at 77,770, more than, get this, 5 times higher than the 15,245 job cuts announced a year earlier. This according from Challenger Gray and Christmas Inc. And right now, it's not going to be Christmas for anybody if we keep seeing these increases in unemployment claims, as we'll look at in a moment. The overwhelming bulk of cuts are occurring in technology, retail, and financial are also cutting right now as consumer spending matches economic conditions. Well, we note that a lot of tech companies overhired. We talked about this in a show the other day, how Facebook was looking, or Meta was looking at another round of layoffs. Well, financial is obvious. With interest rates up, well, what's one of the biggest things in the financial sector people do? Borrow money. Well, people aren't borrowing money, as we talked about in yesterday's show. Well, you don't need a lot of people there. And retail, of course, we note demand there is falling as well. And it was only inevitable that if we didn't see demand turn around, the layoffs would follow. The layoffs that many of these companies are announcing are welcome to investors, sort of the right sizing of the cost structure. Rationalizing growth is being rewarded in the marketplace. And this is a key point, because a lot of people think that, okay, this should lead to a big bear market in stocks. Not so quick. Now, it will eventually if we see an acceleration in unemployment claims, but initially we're not going to see that, because the broad belief is the economy is fairly good shape here, and the companies just overhired it during the pandemic, thinking that growth was going to be better than it was. So the right move, according to the market now, is trim your overhead, get rid of these expensive employees, and the data should come back out in the future showing that your earnings are looking good. There gives you a last boost to the market, which sort of coincides with when the Fed eventually pauses. But one thing that is alarming is not just the fact that the Challenger Gray and Christmas data is showing an increase in planned layoffs. Well, what about those that aren't really planned? That we see the weekly unemployment claims, which suddenly jumped. And we've been worrying about this. Now, at 211,000, this remains overly low historically still. Again, last week at 190,000. But look at this change. A big move higher in 21,000. That was seasonally adjusted. 35,000 if you take away the government's adjustment. But look at this. The weekly continuing claims jumped to 69,000. So it's telling us that people are struggling to find jobs. Well, it makes sense, of course, when you think about the fact that there's all these planned layoffs. Well, if their people are losing their jobs in one place, those in another aren't going to turn and say, hey, I found a job. They're going to see a tough labor market, not tight in terms of what the Fed wants, but in one where there's not a lot of jobs available. If there's any good news in this report, we see total claims slip 38,000 to 1.9 million, but still overall the trend now has started to change. And this points us right toward a hard landing as the deepest bond yield inversion since Volcker suggests a hard landing. Now, I'm going to tie this back to the labor market here in a little bit, but I want to go through and kind of understand what the bond market is telling us, because the front end of the curve, or short-term interest rates, are reacting to the Federal Reserve. And when they're raising rates, or the anticipation they're going to raise rates, what we're seeing is a move higher in 2-year yields. Now, the longer term, those notes and bonds, the 10-year, 20-year, 30-year, what are they telling us? Well, they're telling us about growth and inflation expectations, and what they're suggesting is that growth and inflation expectations are indeed headed down. So when you see this curve inversion, it tells you the Fed's view that inflation is going to run hot is completely the opposite of what the bond market is telling us. As a result, the closely watched spread between the 2- and 10-year yields this week showed a discount larger than a percentage point for the first time, get this, since 1981, when then Fed Chair Paul Volcker was engineering hikes that broke the back of double-digit inflation at the cost of a lengthy recession. A similar dynamic is unfolding now, and now let's take a look at what they're referring to. Here is the 10-year, 2-year yield curve chart. We can note I added this red line here to show you this is the deepest inversion since the 1980s. Now, of course, we're going to look at some more charts here and see how this correlates to inflation. But there's this idea that the bond market, and what I really want you to understand is the bond market is telling us that the notion that inflation is going to continue to run hot, that it's going to continue to rise, is all a bunch of rubbish. The bond market is saying no, in fact, just the opposite is about to happen. And here you can see we'll take the same yield curve, we'll keep that in blue, and now we're going to overlay the consumer price index. We can go back to the 80s. Remember, everyone thinks that we're headed way higher here in inflation, but that inverted yield curve said no. Look at inflation comes crashing down as the curve steepen. We can note that inversions, they don't signal necessarily the peak of inflation. They just tell you that we're near the peak or close to it. And sure enough, the curve steepened, inflation came down. Here we see another inversion, inflation then peaking, coming down as the curve steepen. And again, we see this relationship over and over, that it doesn't necessarily mean that we're past the peak. It just means that it's likely that any inflation that comes in the data is transitory. Here we see this massive inversion telling us that potentially inflation is coming to an end. And when we overlay the two charts and invert the yield curve, now you can see the relationship much clearer here as the two tend to follow each other. So again, we see as the curve steepens, here again showing inverted, inflation comes down. So what we're looking for next is the next shoe to drop. What we want to see is 2-year yields start to fall. That tells us a hard landing in the economy is coming. And when I get to the chart and we look at the labor market, it will become crystal clear that if the Fed is to blame, if indeed the federal funds rate is the problem in the economy, which I don't believe is a real issue, then what it will tell us is the Fed's got this completely wrong. As Nancy Pelosi said the other day, is you keep screwing this up. Well, she's right about that, but what I think she's still wrong about is I don't believe it's the Fed. And longer-dated Treasury yields have failed to keep pace with the surging 2-year benchmark since July, creating a curve inversion that over the decades has amassed a record of anticipating recessions in the wake of aggressive Fed tightening campaigns. So what you're seeing here is the bond market saying, look, short-term yields have to go up because the Fed's been raising rates and they're very sensitive to that. And we can go back throughout history and see that short-term yields tend to move along the Fed. But after the 1980s, and somewhere in the early 1980s, there was a disconnect because long-term yields used to move with the Fed as well, and they stopped doing that. And that's why we get to see now that the long end of the curve is telling us growth and inflation expectations are coming down. If they were headed higher, then what we should see is long-term yields rallying here and following short-term yields up, and they're not doing that at all. In general, such inversions preceded economic downturns by 12 to 18 months, so that means the odds of another occurrence are intensifying after Powell's comments indicate he's open to reverting to half-a-point rate hikes in response to resilient economic data. And of course, we'll see more on what Powell's plans are, at least from the FOMC's perspective, later this month. But what it's telling us is the Fed is ignoring what the bond market is telling us. And of course, it then puts into question what value is the Fed at all. all if it can't even read the most obvious signal throughout history that's told us inflation is coming down? Well, it means they're going to keep raising rates. That's going to lead to a steeper inversion, as we talked about in yesterday's show, means less bank lending, less credit creation, and then you start to see a hard landing isn't far off. And now let's tie this all back to the labor market with this next chart. And here you can see the yield curve with now the 4-week moving average of initial claims. And what we can note is you see these inversions. Let's get in here to the 80s. It's a little clearer. But you see here there's an inversion. And what that tells us that initial claims are somewhere near its low. And as the curve steepens and initial claims rise, here you see it again kind of around 2000, 2001. We see the yield curve inverted, signaling kind of the bottom of initial claims. We see this again around 2006, 2007. And again here around 2019, maybe 2018. So what we're looking at now is the moment that curve starts to steepen, and maybe even sooner, we could start to see, and perhaps that is what we saw last week in the claims data we just looked at, that indeed maybe the labor market is now at a stress point and we're going to see an increase in initial claims. Then we should start to see the curve steepen, and that tells us a recession is almost a likely outcome now. And of course, I'll leave it up to you to decide, does Powell get his soft landing or does he get his hard landing? I think it's going to be a hard landing, and the data from overseas now confirms that. As China's inflation rate slows to the one-year low, casting doubt on recovery. Again, everybody's been pinning the global recovery on China, and it's not so much their internal consumer price index that I care about, it's their producer price index. Let's go right to that. As meanwhile, deflationary pressures on factory goods produced in China accelerated as demand from Western economies softened further. Boom. And so you see, it's all about demand. Demand is coming down. We know why it's coming down, and it has a lot to do without those big stimulus checks. Americans have less money to spend. Then their bills went up due to inflation. Then their cost of their loans. Remember, a lot of people didn't have to pay some of these bills. Well, they came back. That means less discretionary spending, less demand from out of China. Producer prices come down, and next thing you know, you see this spiraling out of control. The producer price index dropped even deeper into what? Deflationary territory. Well, we're going to see a lot more of that word in the year to come in February by falling 1.4% from a year earlier compared with January's 0.8% decline. The bigger uncertainty around China's inflation outlook is its impact on overseas rather than home. And that is a true statement because China's economy is highly sensitive to what goes around the world because they're the world's largest exporter. So if export demand is falling, their economy is going to go down with it. But let's tie this back to the U.S. now because China's producer prices have a big impact on U.S. consumer prices, as you can see on this chart here. We have producer prices, the economic activities out of the industrial sector for China in blue against the consumer price index. It's the U.S. consumer price index in red. And you can see while China's data is rather volatile to compared to the U.S., which is smoothed out, the trend tells us that indeed, if producer prices are negative on a year-over-year rate of change, that indeed is going to pull down U.S. consumer prices as we'd expect. And some other data, and we've been talking about, shipping, container rates. Here we have more data. U.S. container imports plunge as recession fears mount. It should be as demand crashes. And that, of course, demand crashing will lead to a recession. But let's look a little deeper here. As U.S. container imports have slumped, now dropping 20% in January through February from a year earlier, not an indication of a booming economy. What do we see? Container rates are back to about near where they were pre-pandemic, likely to continue falling if we're just seeing this demand component continue to drop. We start to see layoffs increase, demand is going to fall further, container rates are going to fall, and get this, container import declines into the world's largest economy. Now they're talking about the U.S. here, is an ominous sign, absolutely, as there's no demand. As some strategists believe a recession might unfold, well, it's likely to unfold, if not sooner, by the second half of the year. And also rate increases from last year are only beginning to filter in and will strongly curb economic activity. Of course, they're referring to the central bank rate hikes, which shouldn't actually make any difference because nobody actually is doing anything with the federal funds rate unless you've got a credit card balance, and then you start start to see the correlation there. But again, the labor market, you're not hearing people say, hey, I lost my job because the Fed's going to keep raising rates. They're losing their job because demand is falling. And we knew this was likely to happen when you pull away all of that stimulus. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.